Hey there, awesome accounting student. Mark Franke here. This is video for Accounting 101, Chapter 11 on stock transactions. And we are going to use problem 11.2b to illustrate how stock transactions work. So this is in your book on page 447, where the first thing they've done is they've given you a schedule of the statement of stockholders' equity as of December 31 of 2018, and they want us to record the stock transactions that occurred in 2019. The company has common stock. It's got a $1 par value. There are 320,000 shares authorized, which means that they have whatever state they're incorporated in, they've been authorized to issue that number of shares. They have 200,000 shares that are issued and outstanding. When issued and outstanding is the same amount, that means there is no treasury stock. But we're going to have some treasury stock, and we'll get to that in a minute. So that par value of those 200,000 shares is $200,000. There's additional paid-in capital in excess of par value of 1.4 million. And what that means is when they sold the shares of stock, they got more than the par value. And of course, par value is really just an arbitrary amount that you set for your price. The price really ultimately is what somebody will pay for the shares. And then there's a balance in retained earnings of $2,160,000 for a total stockholders' equity of $3,760,000. So our job is to record the transactions that happened during the year and then prepare a statement of retained earnings and the ending stockholders' equity balances. So let's get started. Transaction on January the 10th says they purchased 40,000 shares of its own stock, $12 per share for cash. So we'll start with the date. These all happened, and I'll label this A. And we are going to debit treasury stock. Treasury stock is an equity account, but it's going to be negative. Treasury stock is what happens when we buy our own stock back. Many of the big companies, Apple and Walmart and you name it, they've been buying back their own stock. Why do they do that? It supports the stock price in the marketplace. And we paid cash, so this is going to be to record purchase of 40,000 shares of treasury stock at $12 per share. So I'm going to put that right in the description. And 40,000 times $12 is $480,000 debit treasury stock, credit cash. Then on March the 2nd, they declared a $1.50 per share dividend. Dividend is how we return money to the shareholders. So we're going to prepare a schedule, but before we do that, this is on March the 2nd, 2019, and it's transaction B. What we will do is debit retained earnings. This is going to make retained earnings go down. We are in effect paying out some of the earnings to the owners, and we'll credit dividends payable. We're not going to pay these dividends right now. We just declared them. They'll be paid at the end of the month. So we'll just say to record dividends declared. Of $1.50 on common stock. Okay, so I'm going to insert a line there. The shares outstanding at 12/31/2018 was 200,000. Again, this was right in the book. But now there is shares held as treasury stock. That's 40,000. And we'll put a minus sign in front of that because we're not going to pay dividends to ourselves. So that means that the shares outstanding now is 160,000 shares. And the dividend that was declared was $1.50. So the total dividends are going to be $240,000. Total dividend declared. Debit retained earnings, $240,000. And credit dividends payable. Again, we're not paying it, we're just declaring it. But the next transaction, which is on the 31st of March, is to actually pay those dividends. So I will make this a little smaller so that we can keep these together. And on the 31st of March, we're going to debit dividends payable for $240,000 and credit cash. This is when we actually are sending checks out to the shareholders to record payment of dividend from, we can just reference March the 2nd as the date it was declared. Then on November the 11th, 2019, this is transaction D, it says that we sold 24,000 shares of our treasury stock. So we bought 40,000 shares back in January, and now we're selling 24,000 of them at $13 a share. So here we're going to debit cash. We're going to credit treasury stock, and we're going to credit paid in capital treasury stock because we bought those for $12 a share, but now we're selling them for $13. We're not going to record a gain. We'll only record additional paid in capital. In effect, more capital came into the company, and we'll just say to record sale of treasury stock. Number of shares sold. Price received. Total cash received. So we've got 40,000. Oh, sorry, 24,000. $13 a share. So that's $312. That's how much cash we got. But these we paid $12 for. So we're going to have $1 of additional paid in capital from this transaction. So what we want to do is take out the treasury stock at the same price that we put it in. And because we sold these for an additional dollar, that's going to go into a new account called paid in capital treasury stock. It's just an equity account, and it's going to be a credit because we got more money. Then we sold some more. We sold the rest of them, 16,000 shares. This is on what day? 25th. And for some reason, the share price went down to $19.50. So here we're going to debit cash. We're going to now debit paid in capital. And we're going to debit retained earnings and credit treasury stock. Okay, so let's analyze what that is. This is to record sale. I'm going to copy this from up above here because I can. And this time we sold 16,000 shares at $9.50, which is $152,000. So that's how much money we received. We're going to get rid of those shares. It's just going to be a debit. Oh, sorry. Oh, that's right. It is a debit. The 24,000 that we recorded up above, we got to wipe it out. What we have to do is take those 16,000 shares out at $12, which is $192. And in order to balance the entry, we're going to have a debit to retained earnings for $16,000. That's going to make retained earnings go down. And then the last couple of entries, we had another dividend that we declared. This is on November the 25th. Oh, wait, sorry. This is on December the 1st. This is transaction F. We're going to debit retained earnings and credit dividends payable. And in this case, we have to record dividends declared in the amount of $2.50 per share. So we have shares outstanding. We're back to the 200,000 because all of our treasury shares are now gone. Dividend per share is $2.50. Let's Let's format that so it looks like $2.50. And then our total dividend is 500,000. I'm going to draw a line and debit retained earnings for 500,000 and credit dividends payable. And I've got a little bit of a formatting issue here, so I'm going to fix that. Retained earnings is going down, and we're creating a liability that we will pay sometime in the future. It'll be paid January the 2nd. And then the last transaction, let's get this to stop moving, is to record the closing of the income summary account. So what's happened here is the first two closing entries, revenue and expenses, have already been recorded into this income summary account, and they want us just to show the entry to zero out the income summary account, which of course is going to be the amount of net income. So we will debit income summary, and the net income was $1,072,000, and we will credit retained earnings. We know that retained earnings goes up with income, goes down with a dividend, so that's why we're crediting the retained earnings account. And this is just to close income summary to retained earnings, something like that. So those are all the transactions. And now what they want us to do is to prepare a statement of retained earnings, So on the other tab, I've got some statements set up that look like this. This is the Balthus company or corporation. And here is a statement of retained earnings. And this is for the year ended December 31, 2019. So we're now going to show the retained earnings account rolling forward. And just to help, I'm going to prepare a little schedule over here that's a T account for retained earnings. Retained earnings at the beginning was $2,160,000. That's right out of the book. So we'll just put this as beginning. Then on March 2nd, dividend. And let's make these smaller so they fit better. If I can. Yeah, I can. There we go. The March 2 dividend was a debit of $240,000. The November 25th treasury was $16,000. The December 1 dividend was $500,000, which means, and we also had the net income of $1,072. Here's net income. So the ending balance in our retained earnings account is going to be the beginning plus the income minus the dividends minus the treasury stock transaction. And our ending balance is $2,476,000. And we can now have our check figure. We'll start with the beginning balance. Or let's say the balance at December 31, 2018. That's the beginning balance. And we've got that over here. We'll just reference it in. with a dollar sign. We're going to add net income for the year. That's going to be the 1,072. Then we have less dividends declared. And that is going to be the 240 and the 500. They're going to show up as negative though, because dividends make equity go down. And then we have less treasury stock loss. And so our balance at December 31, 2019 should be 2476, and it is. And I'll draw a line. And down below, we can also prepare and we'll call this stockholders equity section. This would not be a separate statement. This is just the stockholders equity section of the balance sheet, and this is as of December 31, 2019. Common stock, $1 par value. $320,000 shares. Authorized. 200,000 shares issued and outstanding. That's 200,000. This is always going to be the par value. We'll throw a dollar sign on it. We have additional paid-in capital. That didn't change. It's still $1,004,000. And retained earnings is coming from up above. So our ending, we don't want a dollar sign there. But we do want, and I'm going to just borrow this from up above. And so our ending stockholders equity, 4,076. And I'll put a thick line there to show. And there is problem 11 to be. Gone through the whole process of recording the transactions, posting them to the T account so we have a check figure for retained earnings, preparing our retained earnings statement, and preparing our stockholders equity section. That's it for now. Thanks for listening, and I'll see you again next time. Bye-bye.